Assalamualaikum warahmatullahi wabarakatuh everyone. First of all, let me introduce my team members that have been fantastic collaborators throughout this data analysis. The first one is myself, Ain Nadia Ibrahim, Fateen Naziera, Nur Syaza, Izz Anisah, and the last one, Syaidatul Wahidah. As you know, we have just completed our analysis of the financial statements of two major companies. Well, curious to find out which companies we're talking about? Let's dive into the next slide. The two companies that we have analyzed are Petron and Petronas. Both are prominent players in Malaysia's oil and gas industries, but they are different in various aspects, from their business models to their financial performance. Let's begin with an overview of these two companies. We will start by exploring the background of Petron and Petronas, followed by a discussions of the current issues they face and their latest development. Now, let's dive into the details. Petron Malaysia Refining and Marketing Berhad, also known as Petron Malaysia, is a prominent player in Malaysia's downstream oil and gas sector, a subsidiary of Petron Corporation based in the Philippines, and it's officially entered the Malaysia market in 2011 after acquiring ExxonMobil's downstream operations, including its Port Dickson refinery. Petron Malaysia operates a network of over 700 service stations nationwide, offering a range of petroleum products such as gasoline, diesel, and lubricants. The company is committed to innovations, operational efficiency, and sustainability to remain competitive in Malaysia's highly dynamic energy market. Now we are moving forward to the current issues and current development of Petrons. We have three current issues here, which is price controls and subsidies on Row 95 and diesel limit Petron Malaysia's ability to adjust prices and squeezing profit margins. Second, rising costs due to the inflations and economic uncertainties in Malaysia increase financial pressure. The third one, Malaysia focus on reducing greenhouse gas emissions requires Petron to adopt eco-friendly practices. Alright, for the current development, also we have three, which is Petron Malaysia is installing solar panel at selected stations to lower its carbon footprints. Next, the company is upgrading logistics and supply chains for better efficiency and reliability. The last one is Petron collaborates with local stakeholders to support Malaysia's environmental goals and sustainability efforts. The second company is Petroleum Nasional Berhad, also known as Petronas, is Malaysian national oil and gas company, owned by the Malaysian government and established in 1974. Petronas is a vertically integrated energy corporation that operating across the entire oil and gas value chain, including upstream explorations, midstream processing, and downstream refining and petrochemicals. As one of Malaysia's largest revenue contributors, Petronas is pivotal to the country's economies and plays a significant role in international markets, also operating in over 50 countries, and it consistently ranks among the Fortune Global 500 companies. We are moving forward to Petronas' current issues and current development. We have three current issues here, which is Petronas faces challenges adapting to Malaysia's push for renewable energy and stricter. Next, fluctuating domestic oil and gas demand, along with global price instability, which impacts revenue predictability. The last one is public scrutiny and Malaysian net zero emissions target by 2050, which pressure Petronas to transform sustainability. Alright, next is current development. Petronas is focusing on large-scale solar farms and hydrogen energy projects within Malaysia. And the company has launched local carbon captures and storage, which is CCS, initiatives to minimize operational emissions. Next, Petronas is working with Malaysian industry to improve the energy efficiency and drive sustainability efforts.
This is illustration of vertical financial analysis. We focus on vertical analysis with sales. Okay. Vertical analysis compare each line in item to sales expressed as a percentage to evaluate the performance trends. Okay, for sales, the baseline for all calculation representing the total revenue, which is 100% for the 3 years. Second, cost of goods sold, 2021 is negative 94.14%. 2022 is negative 97.10%. 2023 is negative 96.72%. The height and increase of COGS as a percentage of sales indicates rising cost or profit margins over the years. For gross profit, is declined significantly in 2022 but recovered slightly in 2023. It is show the reduced efficiency or increase the cost. Next is other operating income, minor but consistent contribution to revenue. Next is operating expenses. It is declined. Operating expenses relative to sales indicate better cost management. Next is administrative expenses. It is consistently minimal and decreasing. Okay, we move to the profit before tax. It is decline in profitability from 2021 to 2022 and follow partially recovery in 2023. And for the net income, it is decline. The net income margin highlight profitability over the years. Next, we simplified the vertical analysis with sales for asset from 2021 to 2023. For cash and equivalent, cash reserve declined significantly in 2022 with slight recovery in 2023. For derivative financial asset, minimal but steady increase in derivative financial assets. For account receivable, it is decreased in 2022, which is 6.92%, and show improvement in 2023, which is 7.75%. It is means the better credit terms or collection efficiency. For the inventory, the percentage of sales dropped in 2022 and come back in 2023. It is indicating the linear inventory management. For other current assets, it is insignificant contribution with slight fluctuations over the years. For tax recoverable, minor increase but reflect the adjustment in recoverable tax. For total current asset, decreased current asset in 2022, which is related to the sales with modest recovery in 2023. For property, plant and equipment, decline the property, plant and equipment relative to sale indicates reduced reliance on fixed assets. For investment properties, it declined in investment properties but maintained to the 2023. For right of use asset, consistently low significant. Long-term asset, insignificant but steady component of non-current asset. For the intangible asset, which is software, minimal and constant contribution over the time. For total non-current asset, decline in non-current asset share of sales from 2021 to 2022, with slight recovery in 2023. For the total assets as a percentage of sales decreased in 2022, which is 24.98%, but improved in 2023, which is 27.28%. It is reflecting adjustment in asset utilization. Conclusion for vertical analysis of liabilities from 2021-2023. For the total liabilities as a percentage of sales, show the steady decline over the 3 years, indicate the improved financial stability and reduced dependency on external financing. Second, reduction in loan and borrowing. Loan and borrowing, which made up 11.18% of sales in 2021, dropped to 5.52% by 2023. This reflects the efforts to reduce the debt obligation, potentially lower the interest cost and improve the profitability. Third is fluctuation in account payable. It decreased as a percentage of sales from 11.47% in 2021 to 5.89% in 2023. It is better management of supplier payment or changes in procurement strategies. Fourth is minor role of non-current liabilities. It including the retirement benefit obligation and lease liabilities remain a small portion of sales. However, deferred tax obligations show the increase in 2023, rising to 1.12% from 0.65% in 2022, which could imply the changes in tax structures. Okay, the last one is improve financial position. The overall decline in liabilities relative to sales and suggests stronger financial health and better leverage management, allowing the company to focus more on equity funded or internally generate growth. Vertical analysis of equity involves the each equity item as a percentage of total liabilities and equity. This analysis highlights how equity contributes to the overall financial structure and the trends over time. Okay, for share capital, as a proportion of total liabilities and equity has remained consistent at the low level. This suggests that the company's ownership structure has not changed significantly during the period. Second is retained earning. Retained earning from the majority of equity reflecting the company's ability to retain the profits for reinvestment. The slight increase in 2023 highlights strong profitability and retain the profits. For the total equity has increased slightly as a percentage of total liabilities and equity. This reflects the company's strong financial position by growing the retained earning. Okay, analysis for the total liabilities and equities. The total proportion of liabilities and equity indicates the stable and balanced financial structure, ensure that adequate the equity support and for liabilities. Okay, next is vertical analysis of financial data with asset. It evaluates each item as a percentage of total asset, provide insight into the composition and structure of the company's asset. We jump to the analysis. Okay, for the liquidity improvement, growth in current asset relative to the total asset indicates better short-term financial management. Second, increasing retained earnings. A significant rise in retained earnings highlights strong internal fund capabilities and reduce the external finance. Okay, third is asset allocation shift. The decrease in property, plant and equipment and rise in current assets suggests the strategic shift towards the liquidity. Okay, last is liabilities optimization. The reduction in account payable and accrued expenses reflect the effective liability management and enhance the company's financial health.
We are moving to horizontal analysis for 2022 and 2023. Alright, the sales for 2022 is 99.84%. Cost of goods sales 106.12%. Gross profit is negative 1.06%. Results from operating expenses is negative 6.09%. Profit before taxes is negative 2.31%. And the net income is 26.05%. For the 2023, the sales is negative 6.18%. Cost of goods sales is negative 6.54%. Gross profit is 5.86%. Results from operating expenses is 9.90%. Profit before taxes is 22.19%. And the net income is negative 9.49%. Alright, next we move to the assets. For 2022, the cash and cash equivalents is negative 92.09. Derivative financial assets 101.44%. Account receivable 41.86%. Inventories 22.04%. Others current asset is negative 14.69%. For 2023, the cash and cash equivalents is 478.32%. Derivative financial assets is 111.66%. Account receivable is 4.95%. Inventories negative 3.79%. And the last one is other current assets is 54.60%.
Hi, I'm Fateen Naziera binti and I'll be explaining ratio analysis for our group assignment. First is current ratios. In 2021, the ratio was slightly below 1, suggesting that the company might have faced some challenges in meeting its short-term obligations. In 2022, there was slight improvement, but the company was still marginally below the ideal ratio of 1. In 2023, there was a significant movement with the ratio exceeding 1. This indicates a stronger ability to meet short-term obligations. For quick ratio, in all 3 years, the quick ratio was below 1, indicating that the company might have faced challenges in meeting its short-term obligations without relying on the sale of inventory. There was a slight improvement from 2021 to 2022, but the ratio remained below 1. In 2023, there was a more substantial improvement, suggesting an increased ability to meet short-term obligations without relying heavily on inventory sales. For net working capital, in 2021, the net working capital was negative, suggesting that the company might have faced difficulties in meeting its short-term obligation. In 2022, the net working capital turned positive, indicating an improvement in the company's liquidity position. In 2023, the net working capital increased significantly, further strengthening the company's ability to meet short-term obligations. Next, profitability ratio. In 2021, the gross profit margin was relatively high, suggesting strong cost control or competitive pricing. In 2022, there was a significant decline in gross profit margin, which could be attributed to increased cost of goods sold or lower selling prices. In 2023, there was a slight improvement in gross profit margin compared to 2022, but it remained lower than the 2021 level. For net profit margin, in 2021, the net profit margin was relatively high, suggesting strong overall profitability. In 2022, there was a significant decline in net profit margin, indicating lower overall profitability. In 2023, there was a slight further decline in net profit margin, suggesting continued pressure on profitability. For return on assets, in 2021, was relatively high, suggesting efficient use of assets. But in 2022, increased further, indicating improved asset utilization. In 2023, declined slightly compared to 2022, but it remained above the 2021 level, suggesting overall efficient asset utilization. For return on equity, measure the profitability of a company in relation to the amount of money invested by shareholder. A higher ROE indicates better returns for shareholder. In 2021, was relatively high, suggesting good returns for shareholders. In 2022, increased further, indicating even better returns for shareholders. In 2023, ROE declined compared to 2022, but remained higher than the 2021 level, suggesting generally good returns for shareholder. Asset turnover ratio. In 2021, the asset turnover ratio was 0.115 times, suggesting that the company generated RM 0.115 in revenue for every RM1 of assets. In 2022, the asset turnover ratio improved to 0.124 times, indicating increased efficiency in asset utilization. In 2023, the asset turnover ratio declined to 0.106 times, suggesting a slight decrease in asset utilization efficiency. Next, for inventory turnover, in 2021, the inventory turnover ratio was 0.266 times, meaning the company sold and replaced its inventory roughly 0.266 times during the year. In 2022, the inventory turnover ratio increased slightly to 0.275 times, indicating a minor improvement in inventory management efficiency. In 2023, the inventory turnover ratio declined slightly to 0.259 times, suggesting a slight decrease in inventory management efficiency. For debt ratio in 2021, the debt ratio was 0.49%, indicating that 0.49% of the company assets were financed by debt. In 2022, the debt ratio increased slightly to 0.51%, suggesting a modest increase in the proportion of assets financed by debt. In 2023, the debt ratio decreased to 0.42%, indicating a lower reliance on debt financing. Next, debt to equity ratio. In 2031, the debt to equity ratio was 0.521 times, meaning that for every RM1 of equity, the company had RM0.521 of debt. In 2022, the debt to equity ratio decreased slightly to 0.496 times, suggesting a lower reliance on debt relative to equity. In 2023, the debt to equity ratio decreased further to 0.392 times, indicating a significant reduction in the company reliance on debt financing. For time interest earned, in 2021, the time interest earned ratio was 4.42 times, meaning the company's earning before interest and taxes were 4.42 times its interest expenses. In 2022, the times interest earned ratio increased significantly to 10.37 times, indicating a much stronger ability to service debt. In 2023, the times interest earned ratio decreased to 3.84 times, suggesting a decline in the company's ability to service debt compared to 2022, but still remaining above the 2021 level.
Okay, next we move to the ratio analysis for the competitor, which is Petronas. Ratio analysis is a powerful tool used to evaluate the financial performance and health of a company by comparing various financial variables within its financial statement. For the purpose is to determine how efficiently a company is generating profit from its operation. In summary, ratio analysis help business, investor, creditor, and analysts to better understand a company financial standing and profitability, efficiency, and potential risk, guiding strategic decision and action. Okay, next we move to the liquidity ratio. For the current ratio of Petronas, the total is 2.59 times, which is a better firm has a higher ability to meet the short obligation. Okay, the next one is quick ratio, which is the total is 0.68 time, which is lower than the Petron. Okay, the next one is net working capital. The total is 195,018,000. If lower than zero, represent that the amount of the asset are financed with current liability. For your information, the net working capital for Petronas is lower than the Petron. Petron has 5604900. Okay, next one we move to the profitability ratios. For gross profit margin, the total is 41.04%, which is better and is able to control COSG relative to its sales revenue. Next one is net profit margin. So the total is 20.64%, which is better than the competitors and has a better growth prospect and able to generate net earnings to shareholder. Okay, next we have return on asset, which is the total 4.06%. It's lower than the competitors. And last but not least, we have a return on equity (ROE), which is the total is 7.30, is lower than the Petron.
Okay, we have another ratio analysis for the asset management ratio. Okay, for the asset turnover ratio, the total is 0.196 time, which is a better firm is able to utilize its overall asset and good in managing its asset. For your information, the total is more than the Petron. Okay, the next one is inventory turnover. For the inventory turnover, the total is 0.053 times, which is lower than the Petron. Okay, the next we have the solvency ratios for the debt to equity ratio. The total is 0.26 time. Is better represent that more funds provided by owner. Okay, last but not least, we have time interest earned, which is the total is 21.73 times, and is better firm is a good meeting their interest payment obligation. It is higher than the Petron.
Okay, now we will continue with data visualization. So the first one, we have vertical analysis with sales for Petron. So as we can see here, we compare from year 2021 until 2023. So for gross profit, we have the highest one for year 2021, which is 5.86%. Next, we move to net income. So the highest net income is in year 2021, which is 2.60%. Next, we have total asset. Also, we have the highest one in years 2021, which is 46.78%. And then the total liability was the highest one was in year 2021 also. We have 25.34%. The last one, we have vertical analysis with sale, which is total equity. The highest one is in year 2023, which is 27.28%. Next, we have vertical analysis with asset. So the first one, total asset, the highest is for all 3 years. We have 100%. And then we move to total liabilities equity. The highest one is in year 2022, which is 98 and 56%. Next, we move to ratio analysis for Petron. The first one, we have liquidity ratio. So the first is current ratio. So the highest current ratio is for year 2023, which is 1.28%. Then we move to net working capital. The highest is in year 2023, which is 506,049. The next one, we have favorability ratio. So the gross profit margin, the highest in year 2021, which is 5.86%. And then the net profit margin is the highest in year 2021, which is 2.59%. Here we have a return on asset. So the highest one is in year 2022, which is 12.46%. Then we have return on equity. So the highest one is in year 2022 also, which is 13.56%. As for inventory turnover, the highest is in year 2022, which is 0.275 times. Now we move to leverage and debt ratio. So debt ratio, the highest debt ratio is in year 2022, which is 0.51%. And then debt to equity ratio, we have the highest one is in year 2023, which is 0.52 times. The last one, we have interest time earned. So the highest interest time earned in year 2021, which is 4.42 times. So liquidity ratio. Petronas demonstrate a strong liquidity position with a current ratio of 2.59 times in 2024, while Petron shows a gradual improvement from 0.97 in 2021 to 1.28 in 2023, but remains relatively weaker. For profitability, Petronas benefit from vertical integration and diversified operation, ensuring stable profitable, while Petron's downstream focus result in narrower margin and greater sensitivity to market condition. As for vertical analysis, Petron cost-heavy structure reduce in retained earnings, whereas Petronas likely retain more revenue for investment, indicating strong long-term potential. Solvency and leverage. Petronas' larger asset base and likely lower leverage enhance its financial stability, whereas Petron may rely more on debt, increasing its financial risk. Then for market position, Petronas benefit from its dominant market position and government support, while Petron operates in a highly competitive downstream market with greater exposure to price volatility. Investment recommendation. Investors seeking stability, consistent dividend, and long-term growth will likely find Petronas a more attractive option. Its superior liquidity, probable higher profitability, and diversified operation position it as a low-risk, high-value investment. So while Petron showing sign of improvement, carry higher risk due to its narrower operational focus, lower financial buffers, and dependence on downstream market dynamic. Investor with a higher risk appetite, a shallower investment horizon might consider Petron as a speculative opportunity, but for long-term risk-averse investor.